This is FRM Part I, Book 1, Foundations of Risk Management, and Chapter 1, which is really just an introductory chapter. If I can summarize the learning objectives in this Chapter 1, it would be in the following way. A successful risk manager is able to identify the risks, quantify the risks, and then manage the risks. And if you look at the learning objectives, you'll be able to see that theme runs through each one of these. So after this reading, you should be able to explain the concepts of risks and do some comparisons. You should be able to describe the risk management process, evaluate tools and procedures, distinguish between the different types of losses, interpret the relationship between risk and reward, and then identify key classes of risks. So let's get right into the first one and start talking about a definition of risk. Lots of finance textbooks will define risk in a variety of ways. They might use the term exposure, they might use the term hazard, they might use the term uncertainty. I like to think of risk as variability. And so here's a good definition. Think about potential variability of returns around an expected return. Let me give you an example. Suppose that you buy a share of stock today for 100 and you expect to sell it a year from now for 110. I mean, clearly that's a 10% expected return. But what might happen during the next year is that price might be 120 or 140 or 180, or it might be 80 or 60 or $40. And so that variability, that price variability, is a good definition of risk, but let's not worry about the prices, let's worry about returns. So variability of returns around an expected return. Financial risks can be managed. What that means is that they can be reduced. They can be mitigated. And in fact, good financial risk managers then have a great idea of how much risk ought to be reduced. And in fact, and sometimes risk can be reduced all the way to zero. Now, in traditional financial management, of course, in order for an investor to receive some form of compensation, like a return, they have to take risk. Now, there's a comma there, and let me speak parenthetically that there are arbitrage conditions that allow some investors over very short time periods to generate a positive return without taking risk. And we'll talk about arbitrage in other readings. But for now, let's just make the assumption that there is no return without taking risk. Now, one of the cool things that risk managers are able to do is the following. Let's suppose that we're exposed to some risk, and the risk is this big, whatever that means. The risk is this big. A financial risk manager is able to assign a value to that length between my two hands. For example, a financial risk manager might say, hey, in order for me to completely eliminate that risk, I'm willing to pay $10. Or I'm willing to pay $5 to cut that risk in half. Examples of this include financial institutions like JP Morgan Chase, who are faced with credit risk every time they lend money. I mean, remember, financial institutions generally accept deposits and make loans. And so there's constant credit risk. And the executives of financial institutions are hired to maximize shareholder wealth, right, to generate a return for shareholders. But in order to do that, they need to manage things like default on all of the loans that it makes. Now, here's a good table that is much more subtle and sophisticated than those kind of three elements that I gave you in the first slide. Notice in the table over here, we start with identifying the risk exposures. And this is really an interesting process because historically, at least up until 10 years ago when we had this global financial crisis, risk managers tended, not always, but they tended to use historical statistical data and treatment of risk and risk management. But if you use historical data, what you're relying on is the fact that history is going to repeat itself. And of course, the financial crisis in 2008 was unique in and of itself. There wasn't a crisis in 2006 or 2004 and 2002, right? During those periods in the United States under the George Bush presidency was a relatively stable period, of course, with the exception of September 11th. But really, none of those events in the early 2000s were an indication of what was going to happen in 2008. So what this crisis has enabled risk managers to do is to use some other risk management tools like scenario analysis and stress testing. And if you're a regular reader of the Wall Street Journal, like you should be, you'll read articles all the time. The Wall Street Journal editors are big on the stress tests. And there are battles going on between and among financial institutions about what is the best way to test the stressing points, like if we have a collapse in the equity markets, or if we have a collapse in the fixed income markets, or if oil prices spike, what's going to happen to the value of the assets in our portfolio. And then scenario analysis enables companies to say, okay, what happens if something really, really good occurs to our product lines, or something really, really bad occurs to our product lines? All right, so after we identify the risk exposures, then we're going to measure them. And then the coolest thing is that we're going to find instruments to manage those risks, whether it's a derivative security or an insurance contract. And then we're going to do lots of assessment. And this is no different than what you learned back in your introductory microeconomic days, right? Marginal costs and marginal benefits. I teach my children this all the time. Assess the costs and benefits of the process. And then, of course, we need to form some kind of a strategy. Are we going to reduce risk? So let's call this a risk mitigation strategy. And the example that I'd like to give here is kind of a silly one, but I think it illustrates the point. Let's suppose that we are the Wicked Witch of the West back in The Wizard of Oz. And what do we know? We know that if we get rained on, we're going to melt, right? I think that's how the movie ended. And so how can the Wicked Witch of the West manage the risk of melting? Well, when she looks outside and sees thunderclouds, she can just stay inside, right? She can avoid pursuing those activities that are going to expose her to that risk. So she can just avoid it. She can transfer that risk. She can ask her sister, the Wicked Witch of the East, to go out and run her errands for her. Of course, the Wicked Witch of the East, got landed on by a house. She can mitigate the risk by using an umbrella or some other form of protection. And then she could just say, you know what, I'm going to go out and see what happens. She could keep the risk. And the important thing of this for not only the Wicked Witch of the West, but also for financial institutions and other organizations that are exposed to these kinds of risk is to be able to evaluate the performance. And so look, initially what we're doing is we're measuring and assessing, and then we're going to pursue a strategy. But then we need to have some feedback. And so we're going to evaluate the performance and look back and say, okay, when I avoided the risk, the following events occurred. When I transferred the risk, when I mitigated the risk, when I kept the risk, the following events occurred. That way, we know that we can make better decisions going forward. Now, risk management is a process. So we want to understand, we want to cost, we want to efficiently manage the unexpected levels of variability. And that's a key focus of risk management, the unexpected levels of variability in financial outcomes. What we want to do is not focus on the business efficiency concern, which revolves around controlling and reducing those expected losses. Let's go ahead and continue this conversation, risk management as a process. And so the point of this slide is to simply mention and focus that even conservative businesses can take on significant amount of risk. And this depends on a couple of different factors. Confidence levels in the way that those unexpected loss levels are assessed and measured, and then accumulation of sufficient capital, deployment of other risk management techniques. And then, of course, we've got to learn from those risky activities and how they appropriate returns. And once the costs of risk capital and risk management are taken into account, then we're better able to identify those risky activities. And then, of course, we need to communicate with all the people who are relevant to the firm. So let's go ahead and distinguish between those two types of risk that I mentioned in the first slide. Risk, variability of returns, and that can be quantified in terms of probabilities. Uncertainty is a variability that cannot be quantified. How about some challenges to risk management? I mean, during stressful conditions, it's really difficult to predict. Let's take this example. Let's suppose that we're all going to see a movie and we're in a crowded movie theater, and the movie theater is shaped like a triangle, like a rectangle or a square, and there are exits at each of the corners. Now, we could go to the movie house every day for the next 50 days, and when the movie's over, the lights come on and we orderly file out. Some people go in each different direction, but it's orderly. Everyone gets out safely. But let's suppose that 5 minutes before the movie ends, that the electricity goes out and the theater is completely dark. And there's an announcement over the loudspeaker that says, no electricity for the next 10 hours. You need to leave. And let's just suppose that one of those doors somehow gets locked. Well, wow, during this stressful condition, there's no telling what's going to happen, right? I mean, the people near the exits, they're probably going to be able to kind of feel their way and get out. But the rest of the people, who knows what's going to happen to them? And so what happens here is that during stressful times, those correlations between and among the various asset classes has been known to increase. And so just when we need the diversification, right, we have a diversified portfolio of equities and fixed income securities and derivative securities and alternative investments, you know, like an investment in an oil well or a stamp collection or maybe some movie memorabilia. And so what happens during a financial crisis? All of the values of those assets falls, which means their correlations increase during those stressful times. So it's really difficult to predict what's going to happen. Risk management is often subject, of course, to monetary constraints. We're always faced with monetary constraints. I mean, what could the Wicked Witch of the West have done? She could have just built a big dome over her land and wouldn't have to worry about the rain. But of course, that probably would have cost too much. I have no idea how much things cost back in The Wizard of Oz, but it's still not a bad analogy. As an entity grows, of course, its risk profile grows as well. I mean, think of Apple, you know, however many years ago that was. What are we talking now? 35 years ago? It started out with just a small company with a couple of dudes, and they decided to build, you know, whatever they decided to build, this little machine, and you could do stuff on this machine that you couldn't do before. And now, I mean, before Christmas, you know, we had a little bit of a correction before Christmas of 2018. You know, Apple was the first company that became a $1 trillion market cap. So, of course, its risk profile has increased. Fast changing technology. I mean, here's the example that I like to use. You know, I bet you guys have heard of this whole blockchain thing. And, you know, like the Bitcoin and all the other applications. It's really fascinating, this fast changing technology. I mean, think about it. If you and I are working on an Excel spreadsheet and we work on it and I add something and then I attach it to an email and send it to you and then you work on it and then send it back and forth, you know, it's going to take some time for us to, you know, to come up with a final model. But if we somehow put this out there somewhere, maybe on the internet, but maybe somewhere else, and we invite 100 of our best friends to work on this, and so that all of us can be working on it at the same time, and anytime we make a change, a consensus, let's say 50% of us or maybe 75% of us have to say, you know what, that's a good change, we'll accept it, and then that change becomes permanent. And we don't have to limit it to 100. We could make it available to everybody in the entire world. And you think about how that document changes, fast changing technology. But then with all that technology, there becomes all these extra risks, cyber risk and money laundering and risks about blockchain that I'm not even aware of. Maybe you guys are better able to handle that stuff. And then the agency conflict. You know, this goes back to the simple fact that there are some agents who are hired to manage the capital of the principals. And so there might be competing goals, like the individuals are always going to make decisions that maximize their own interests, whereas executives in a publicly held corporation are supposed to make decisions to maximize shareholder wealth. And so the agency issue is always a problem in risk management. How about the difference between expected loss versus unexpected loss? So the expected loss is the average credit loss that we would expect from an exposure over a given period. And so you can think of it as the anticipated or the expected deterioration in the value of a risky asset. The unexpected loss, however, is the loss over and above the expected loss. So if you combine expected and unexpected losses, you get the portfolio loss. And so modern portfolio theory gives us some good tools to manage the expected loss, but then we need to figure out some other ways to manage the unexpected losses. And of course, we're going to use some of the statistics that modern portfolio theory has developed to help us manage unexpected losses. And then, of course, there's an upward slope. If you have low risk, you're going to have low expected return. If you have high risk, you're going to have high expected return. However, here's a big problem. One of the things about modern portfolio theory is that those men, like Harry Markowitz and William Sharpe, they relied on an efficient and transparent market. And things work really well if markets are completely efficient and completely transparent. But what we know is there are pockets of inefficiency for a variety of reasons. And so those expected or demanded returns might not be clearly able to be identified. All right, so what our key objective here is to make transparent all of the potential risks. How about classification? So let's look at some risk measurement tools. Value at risk is a maximum amount of loss that can be incurred at a given level of confidence. Let's suppose you have a $100 portfolio and the value at risk is $5 and you have a 95% confidence. So what you can say is something like, hey, there's a 5% chance that our portfolio is going to be worth less than $95 at the end of a period. But there are some good things and bad things with value at risk. We'll talk about that in just a little bit. Lots of financial risk managers are looking at worst case scenario analysis. I teach this to my students all the time, is that especially when we're doing a capital budgeting project and we're trying to determine net present value, I say to them that highly skilled executives look at this project and say, what's the worst thing that can happen? And for capital budgeting, the worst thing that could happen is that nobody buys that new product line. But coupled with that worst case scenario is a relatively new management tool called enterprise-wide risk management tools. And so rather than manage the risk in terms of silos, and I want you to think about this in terms of a financial institution that makes mortgage loans, there's one silo, and it makes automobile loans, there's another silo, and it makes personal loan, there's another silo, and you can have a bunch of silos, of course. But the ERM tools will include a risk management sense of being able to umbrella each of those silos so risk managers in each of those silos are not making decisions independently of each other, but rather dependent on what everybody else is doing. Now, once a classification of the risk is done, it can be quantified. This is such cool stuff here. Being able to say, all right, here's a risk. And, I can say, all right, we have about this much risk. But to be able to assign a number to that is really fascinating. And so, of course, when you rank them, you can make rational in-class comparative decisions. You can even assign numbers to some risk factor, like a credit risk factor. Or if you're looking at, one of these silos, if we're looking at mortgage loans, you can assign numbers to things like income. You can assign numbers to things like job security or the value of the assets, or a number like my daughter just recently bought a house, whether or not one of the parents is willing to co-sign on the loan. Of course, all of these things are important in terms of quantifying the risk. Now, if an absolute cost or price is put on risk, then rational economic decisions, of course, can be made. And those economic decisions go back to that very first thing that I said in that very first slide. We're going to identify the risks and quantify those risks, and then we're going to manage them. And what manage means was the whole Wicked Witch of the West idea. Now, the risk management decisions can become fungible, especially in the ERM model, because what we can do is kind of substitute decisions between and among all of those financial risk managers. All right, how about value at risk? This works under normal conditions and generally short time periods. Lots of people like to say something like, hey, you know what, I'm a financial institution and I have this fixed income portfolio worth $1 billion. Well, what's the value at risk by the end of the week? You know, let's do a weekly measure of value at risk. But sometimes it can be misleading and it can be poor in terms of measuring risk in longer time periods, you know, like a year. You know, value at risk over a year, I mean, that might be relatively important for maybe a high net worth client who doesn't have too many liquidity needs, but lots of people have liquidity needs, and that's why it's a concern for portfolios that don't have much liquidity, or if there are abnormal markets, which can be defined in almost any different way. Abnormal meaning, you know, maybe there's not a lot of price discovery, maybe the markets are not terribly efficient, maybe there's not a lot of liquidity. Now, the risk manager, of course, identifies the potential sources of risk and makes those sources of risk visible so that everybody who's involved in the decision-making process can see it. How about the different types of risks? And so we can go through this fairly quickly here. Market risk, what are those things? Like risks of movements in prices and interest rates and exchange rates. Credit risks are, you know, changing credit ratings, changing credit scores. Embedded in there is some kind of a default. Liquidity risk is always the ability to meet those short-term obligations. And liquidity in financial markets means that there are a significant number of buyers and sellers to support that secondary market, so that if you have a liquidity need, you can go to that secondary market and you'll get your money back. Or in other words, you'll be able to sell your security. I always think of operational risk as kind of variability in profits. You know, whether you look at the very bottom of the income statement and call it net income, but it's probably more appropriate to look at the middle of the income statement and call that operating profits. Legal and regulatory risk. I always go back to the early 1980s when the Tylenol had the cyanide poisoning put into their capsules, and Johnson & Johnson, who was producing Tylenol, they immediately came out and had a great public relations process, cooperated with authorities, but then they were the first to put the little lid, you know, the everything that you buy these days, that, you know, there's a seal on top of it so that nobody can tamper with it. Business risk, I like to think of that as variability in revenues and the variability in expenses and any kind of variability that has to do with the businesses and the business operations. Strategic risk, this goes entirely to either the board of directors or whoever the people who are in charge of establishing, you know, the strategy or the mission of the company. And then reputational risk, this links back to the Tylenol thing. How about market risk? Changes in financial market prices and rates. There are two components. I always learned it back when I was in graduate school. I learned it in terms of systematic risk and unsystematic risk. Systematic risk, which is, you know, kind of general market risk. That's the variability in returns due to changes in economic factors, things like inflation and exchange rates and interest rates, and unsystematic risk. But nowadays the term is idiosyncratic risk, as these are the risks that are specific and unique to each individual company. Now, there's a risk that arises from both open positions and from imperfect correlations. Of course, if you have this open position, that means that it's not hedged. There's going to be certain risk. And then correlations, they're not perfect. They change. First of all, they change. They're not +1 or -1. How about some classifications here? Interest rate risk. This is just fluctuations in market interest rates. I mean, what do we know? A bond portfolio has a yield to maturity. What happens to yields? They go up. And when yields go up, bond prices fall. That's why we spend so much time talking about duration and convexity. Equity price risk. This goes back to the systematic risk that I was talking about just a second ago. And remember that investors can hold well-diversified portfolios, but those well-diversified portfolios will have eliminated, or what we say in the academic world, they virtually eliminated the unsystematic risk or the idiosyncratic risk. But there's no way that investors can do anything to systematic risk. But remember, investors get to pick their level of systematic risk by picking the level of beta that they choose in those individual securities, or by picking the specific factors if we're going to do some factor-based modeling. How about foreign exchange risk? Of course, this is relevant for international firms. And I'm always fascinated when I read in the Wall Street Journal about firms who suffer from foreign currency losses who don't hedge. I mean, it makes perfect sense to me if you're a U.S. firm like Coca-Cola, and Coca-Cola gets a majority of its cash flows from outside of the United States. I mean, it makes perfect sense to use a forward contract whenever you can. Of course, foreign exchange risk can't be completely eliminated. I mean, it can be in the short term for major currencies, but over a long time, there's always going to be some foreign exchange risk. Commodity price risk. I love this one. You know, commodities are things like wheat and corn and orange juice and gold and sugar. And so the volatility of these prices, of course, affects the value of companies like Southwest Airlines. I mean, what does Southwest Airlines do every day? Every day they buy oil or gas. And so during rising oil prices, their inputs are higher. And so their profitability is going to be lower. And so commodity price risk, because of the proliferation of forward markets and futures markets and even swap markets, these are relatively easy risks to reduce or even eliminate. Now, here's a big table, a schematic of financial risks. I'm not going to go through all these, but this is what we've talked about here. Financial risks all the way through, defined as things like market risk and credit risk. But then these are the other risks that we have talked about. So this is probably a good table to spend a few minutes identifying and giving examples for each one. How about credit risk? There's a couple of components inside of credit risk. And so when I think of credit risk, I mean, in the general big picture sense, I think of not getting paid on a loan. And so there are a couple of different components to this. So default risk is really just the inability or the incapacity of the borrower to meet the obligations. And it's not just the inability, it's also just the refusal. I mean, you could lend me $100 and I could promise to pay you $110 at the end of the week. And I may not have any money by the end of the week, so therefore I'm unable to pay you. But I might have $110. I might have $200 or $300, but I may just look at you and say, I'm not going to pay. There's also bankruptcy risk, and so this is kind of more firm-wide. You know, when there's an inability to clear the debt, then we bring in the legal system. Downgrade risk. This, of course, occurs when a ratings agency like Moody's or Fitch, when they look at a borrower and they say, you know what, this was a triple B rated bond, and we've seen some things inside of the variability in revenues and the variability expenses that we don't like. That spread is narrowing, and so we're going to downgrade that to double B. And then settlement risk. You always have settlement risk because when there are counterparties, because you have terms of the agreement, like, you know, hey, I'm going back to my example, I'm going to pay you $110 at 1 o'clock on the corner of Wall and Broad Street in downtown Manhattan. And I may not show up until 5 minutes late or 20 minutes late. And then when I get there, I might say, oh, will you take a check? I don't have the cash. That's settlement risk. A couple of things about credit risk. The value, when there's a credit risk, you have to assign a value, and this is called the recovery value. So if I owed you that $100 and I'm not able to pay you, I may come to you and say, hey, I owe you 100. Will you take 75? And you may say, all right, I can either take 75 now, or I can take Jim to bankruptcy court and I can sue him, but I may have to pay $26 in lawyer fees and transaction fees. And so that's the recovery value. And then you got to calculate the loss given my default. And so the issues are creditworthiness, and then concentration risk. And this has everything to do with diversification. And then, and you can't ever forget about the state of the economy. I emphasize this to my students all the time. Students are always tempted to say, oh yeah, it's a great time to invest in equity securities. I can buy low today and sell high tomorrow. But sometimes the economy is telling you that it's not a good time to invest in equities. How about liquidity risk? So the big picture liquidity is really just, the sense of being able to sell an asset and get your money back quickly. But there's funding risk. And so this is the risk that a firm will not be able to settle its obligations immediately. Now, sometimes they might not be able to settle because it doesn't have cash flow coming in, but it also might mean that they are unable to roll over the debt. That might mean that they're unable to meet their margin calls or have some kind of collateral requirements. So how do we manage this liquidity risk? Well, the temptation is to say, all right, I'm not going to hold any illiquid assets. Trading liquidity risk, on the other hand, centers entirely around the ability to execute transactions at the prevailing market price. And this is very common in the fixed income market. You might look and the last trade might be at 98, and when you want to go to sell, there might not be any buyers out there. And so you might not get that 98. You might get something different. And what this trading liquidity risk does is, if this is substantial enough, it's going to reduce the financial institution's ability to hedge different types of risk, but especially market risk. So what did we just say? Financial risk and market risk and credit risk are all components of this liquidity risk. So liquidity, which in the simple sense just means turning the assets into cash, has much more complex features. That's why this table 4 is called the dimensions of liquidity risk. About operational risks. So these are the risks that arise due to operational weaknesses. And sometimes these have to do with stuff that goes on inside of the income statement, but it can also mean poor management decisions or total management failure, inadequate systems design, or maybe faulty controls throughout the operation. So think of a company like Harley-Davidson that has these gigantic metal stamping machines, and they bend and they pound and they do all sorts of metal, and at the end comes this really cool motorcycle. And so those operational risks, those operational weaknesses are variabilities on the expense side of the income statement, which can be a factor of all of those things. Of course, the human factor risk is a part of that. Technology risk is a part of that. Legal and regulatory risk. Remember, there are laws out there that are going to say you can do this and you can't do that. But then there are regulatory bodies out there that offer suggested or best practice. And then there's a punishment if you don't meet those regulations. Business risk arises from the uncertainties in the demand and the cost of production. So think of this as the demand for a particular product line and then the ability to produce that product line inside of a factory. And so this is managed by marketing strategy, marketing policy, inventory policies, the choices of products. Of course, that's the capital budgeting decision. And then the entire supply chain. And so it's probably best to think about business risk as managing that supply chain. And so think about, just think about a company that manufactures snow shovels. I'm here in the eastern United States. We just had a giant snowstorm. So a company that manages snow shovels. And so over here on the supply chain are things like, I don't know, how do you make a snow shovel? You got plastic and you have bolts or screws, and you have a handle that's probably made out of plastic. You probably make some out of wood, right? Maybe you make some out of aluminum. So you can buy this stuff from all these people over here, and then where are you going to sell? Where are you going to sell the finished product? Probably at places like Walmart or any of the local stores. Strategic risk. This is the board of directors. So the board establishes the strategy, and the board and the top executives say, all right, this is what we're going to do. We're going to spend $10 billion by doing all this stuff. About 10 years ago, AT&T raised about $8 or $10 billion in capital, and they invested substantially in improving their technology by investing in, all sorts of stuff, cell towers and satellites. And so, this is a tremendously high requirement for investment capital. Reputational risk has a lot to do with ethical practices, trust and fair dealing. Reputation means that, hey, when the institution owes somebody money, it pays on time, and it pays in the full amount, and that it treats both of those ends of the supply chain with respect. Systemic risk has everything to do with one institution failing and creating a chain effect. We call that contagion in the academic world. And of course, the Fed and the politicians talk about, too big to fail. And so that one institution can be big enough, if it fails, would lead to a collapse of the entire economy. Those of you who are regular readers of the Wall Street Journal will know that there's a big battle going on between and among these financial institutions and the federal government here in the United States, that really what defines too big to fail? Who are these institutions, and is it really a good definition? I'm fascinated by the battle that goes on there. And that takes us through the learning objectives. So clearly we've talked about all of those. And next up is going to be corporate risk management.